We all know what a couch potato is. Usually, these people are looked at negatively by society, spending all their time lying in front of the TV, wasting their lives away. So when the term couch potato portfolio was mentioned, you would think that this portfolio is for lazy people, for people who don't know what they are doing. If I mention financial advisors, however, you would think that these people are smart, and that they know how to invest money. But what if I told you this wasn't the case? What if I told you that the couch potato portfolio has historically beaten 80% of money managed by professionals, and that it really is for the couch potato? That is, you only need to spend about 15 minutes a year looking at your investments. Would you still think negatively about this investment strategy? The couch potato portfolio was created by Scott Burns, a newspaper columnist and author who has covered personal finance and investments for over 30 years. Basically, it's based on the fact that the market is smarter than any individual. If the market has grown 10% in a given year, chances are the stocks in that market have performed roughly 10% as well. For any individual or actively managed fund to beat that 10% is highly unlikely, and this is even before we consider the high fees and taxes. So taking this into account, how do we create a simple but diversified portfolio? Scott Burns says that the best way to do this is invest 50% of your money in lower-cost stock index funds, such as the S&P 500 index, and the remaining 50% in a low-cost bond index fund. This way, you're not trying to time the market or select the best stocks or bonds. You're going up or down with the market itself. What's cool about the couch potato portfolio is that it meets Warren Buffett's standard of being greedy when others are fearful and fearful when others are greedy. If, for example, stock prices are falling, what you would do to rebalance your portfolio is to transfer money from your bonds to your stocks. Even though others are selling because they are fearful of the falling market, you take advantage of this situation to buy stocks at a discount. If they fall even further, great. You get to buy the stocks at an even greater discount, and you buy knowing that the stock prices will rise to much higher heights sooner or later. Of course, it is not required of investors to split 50-50 between stocks and bonds. For younger investors who are willing to take more risks, the ratio can be split to 75-25, even up to 80-20. Same goes for older investors. If they are nearing retirement or are in retirement, they can split the ratio to be 25-75 for that extra safety. So now let's take a look at a sample couch potato portfolio. Let's say the portfolio is split 60 to stocks and 40 to bonds. To add some diversification to the portfolio, we split the 60% into two stock market indexes, the Vanguard 500 Index Fund that traces the US S&P 500 Index, and the Vanguard Total World Stock Index Fund, which traces world stocks. For bonds, we invest in the Vanguard Total Bond Market Index Fund, which traces US corporate and government bonds. This way, we not only meet our requirements for asset allocation by splitting between stocks and bonds, we also have international diversification as our money is spread across two stock market indexes. So how would this portfolio perform? Well, let's say we invested $10,000 in the year 2004, 10 years ago from today. That would mean that $3,000 was invested in the World Stock Index, $3,000 in the US Stock Index, and $4,000 in the US Bond Index. Taking into account the average annual growth of these three indexes, which are 5.4%, 11.02%, and 4.4% respectively, our $10,000 invested in 2004 would now be $19,762. This is an average annual return of 7.05%, and this is even without calculating the scenarios where we transfer money from bonds to stocks, when stock prices are low, and stocks to bonds, when stock prices are high. If we included that, this percentage would be even higher. The couch potato portfolio has even historically beaten hedge funds. Hedge funds are basically active funds on steroids, where some of the richest people in the world pool their money together so that a super smart investor can invest it for them. Even though the average annual return of hedge funds has been higher than the couch potato portfolio, due to their insanely high fees and taxes compared to the negligible fees of indexes, the couch potato portfolio has consistently beaten them by far. After hearing all that I've said, would you think negatively if someone mentioned the words couch potato portfolio? I hope not, and it is by far one of the smartest investment portfolios out there. By starting now and saving to invest, we can have a great deal of money in just 20-30 years. So what are you waiting for? Get out there and be the next couch potato investor.